Vamos con ello. Esta mesa se llama Monedas Digitales, repensando el futuro del dinero. Y tenemos el honor de contar con ponentes de la talla de Martin Wolf, editor asociado y principal comentarista de economía del Financial Times, premiado hoy por el Premio Construcción Europea. Mariona Vicens, directora de Digital Transformation and Advanced Analytics de CaixaBank. Y Stephen Cecchetti, profesor y titular de la Càtedra Rosen Family en Finanzas Internacionales en la Brandeis University, que se unirá a este debate en remoto. Moderación a cargo de Xavier Vives, profesor de IS Business School, presidente del Consejo Asesor de Iniciativa para la Productividad e Innovación del Cercle de Economía. Sesión en inglés, pueden obtener uno de los traductores. Xavier, quan vulguis.
Thank you. Bona tarda. Bona tarda a tothom. La nostra tasca és mantenir-vos desperts fins l'hora de sopar. Aquesta intentarem, ara que ha estat un dia llarg, però ho intentarem. Welcome to the roundtable on digital monies, rethinking the future of money. As you know, money is changing because of the impact of technological change, digital technology in particular. We have the cryptocurrencies, Bitcoin. We have this new boy in town, which is stable coins. So this is also digital coin, but with one-to-one backing with typically a hard currency, typically the dollar, could be the euro. They also use typically the blockchain technology. Then central banks are also thinking about that, about this technological change and whether to introduce digital euro. The US does not want to introduce a digital dollar. We'll discuss this. In the euro, this is a project with Horizon 2029. And this raises fundamental questions about privacy, about monetary sovereignty, about financial stability that we'll be talking about. The private sector is reacting. So in fact, the private sector is also issuing stable coins. I think we'll have an example here soon, or we'll have an example soon here in Europe with Kivalis, and which will be, I think, one of our speakers, Maria, may talk about it. But let me start with some quotations, which I hope appear. Have they appear? Yes. So, no, that's the second one. Back. Okay. First quotation. So this is a quotation from Piero Cipollone, which is a member of the executive board in April 2026. And was one of the issues behind the digital euro, no? The cash use has been declining rapidly from 68% of day-to-day transactions in the euro area in 2019 to 40% in 2025. Okay, so that's an important change. And Piero said, the digital euro is the Eurosystem's response to this structural gap. Okay, but not only. This is not only a technical thing. It's not only because its cash is declining. President Lagarde from the European Central Bank said the digital euro is not just a means of payment. Okay, it's a political statement concerning the sovereignty of Europe. Okay, so this links nicely with the lemma, the strategic autonomy of this, of today's jornadas. Okay, so in any case, the different jurisdictions have different approaches to digital money, the US, Europe, and China. The US has changed its position on cryptocurrencies. Now it's fostering stable coins. Okay, so these digital coins which are not so volatile as the Bitcoin, but not the central bank digital currency. In fact, the Trump administration has forbidden to talk about the central bank digital currency, and it's fostering the private stable coins. So, China is moving ahead with the digital yuan, but people do not use it. Why do not use it? Because they have a very efficient payment system already, and they use the wallets, the private wallets of the big techs. In any case, what's clear, as Lagarde was saying, that Europe's strategic autonomy also depends on the sovereignty over monetary policy, over the monetary anchor, and to the payment system, which, by the way, in Europe, payments are very much managed in terms of infrastructure by infrastructure in the hands of the US big tech, be it in the cloud, be it with iPhone, or whatever. And also with the networks of credit cards, Visa and MasterCard, which are also thinking about stable coins, obviously. Why is important for the US this push for the stable coins? Because they are thinking, and so we can discuss that they may help the dollar to remain at the center of the international monetary system. So here, in a quotation on a report that we just released today with ESA and CPR, which in fact is called the Barcelona Report, it's the 8th edition on digital money, which I am a co-author jointly with Steve Cecchetti, which will be here. We say, we mentioned that US stablecoins are by far the most developed segment of that crypto ecosystem. More than 99% of the issued stablecoins are pegged to the dollar. So when you talk about the stablecoins today, you are talking about the dollar, basically. Okay, we'll see in the future. And then two of the main players in the US on stablecoins are Tether and Cercle. Now they hold collectively more US treasuries than Saudi Arabia. Okay? So this is one of the ideas of the current administration, that the stablecoins may help increase the demand for short-term treasuries and contribute to finance the huge debt of the administration and the huge debt of the US administration, which is growing. Okay? So this is the report that you can download from my webpage or the CPR webpage. It's also together with Dirk Nippelt, which is a professor at Bern, and Ellen Ray, which is a professor at LBS, and she's the incoming chief economist at the Bank of International Settlements. But that's not all, and let me just show you a couple more of slides. Cryptocurrencies have helped a lot illegal activities. Okay? Here we mention that illicit blockchain addresses receive at least 154 billion in 2025, 15-fold increase from around 10 billion in 2020. But more interestingly, and this is in fact what we have in this graph. So this is the total cryptocurrency value received by illicit addresses, you name it. Terrorism, stolen funds, malware, ransomware, fraud. When someone kidnaps your computer, you pay through these illicit addresses. You see the pickup in 2025. But it's not only that. It's that in 2020, these transactions were basically conducted with Bitcoin. So when you had your computer kidnapped with ransomware, you paid in Bitcoin. Now you pay in stablecoin. Okay? Why? Because there are more stablecoins in circulation, and because these guys, the bad guys, have become smarter. So the stablecoins are more stable. So the Bitcoin fluctuates a lot, so it's not good to receive a money which may fluctuate a lot. Okay, so this is enough as an introduction and general motivation, I think, basically. And so let me start with some round of questions for our participants, including Steve, that could appear momentarily, because I'm going to ask the first question for Steve. Then we'll have a second round of questions, and then hopefully questions from the audience. So, Steve, hello. How are you?
Very well, thank you.
Okay.
I'm sorry I couldn't be with you in person.
Okay. We know, but we take a rain check, you will have to come back. So, Steve, what is from the lessons that we learned on the report that we wrote, what do you think is the future of money? Will these US stablecoins take over the world? How we should regulate all these? No? So give us just some light on that.
Yeah, thank you. Let me give you a few thoughts. I want to start with the first observation, which is that all of finance is a database, some code, and a set of protocols for who can change what. Money is no exception to that. So deposits at banks or electronic ledger entries. What's new is the structure of these databases, the nature of the code, and the design of the protocols. That's what tokenization, programmability, and distributed ledgers are. I would say that the central lesson of our report, and my own views conform with this surely, is that it's not technology, but it's institutions that determine how it is that money functions and whether something is money. And the institutions and the technology have to fit together, so that's one of the reasons I think that we're struggling right now. But without the right institutional foundations, no technology is going to produce reliable money. And so let's start with a sort of simple, go to a simple fact, which is that there are two kinds of money out there. There's public money that's issued by central banks, that's largely paper currency that we hold and most of us don't use. And that only accounts for about 10% of the total amount of broad money that's out there. That's a number that's consistent across major US jurisdictions like the Euro area, the UK, and the US. Now, the question then to ask when you look at new forms of payments or stores of value that people want to call money is whether or not they're going to be generally accepted with no questions asked. If you bought a cup of coffee this morning, my guess is that you tapped your phone on a piece of payments technology, but the barista or the person in the coffee shop did not ask you anything about your bank. This general acceptance, though, is not automatic. And so it rests on institutional foundations that I think are really important for us to keep in mind when we look at these new forms and things that we generally don't think about. So I would list these as the convertibility into central bank money on demand at par, the ability to settle transactions on central bank balance sheets, and the ability to have a central bank that acts as a lender of last resort. If you take any of these away, history teaches us that this gets fragile, this whole system. Now, you asked also and mentioned the ideas of central bank digital currency. People make the case for central bank digital currency, aside from the purely political one, which was President Lagarde's case, on the basis of that it will improve payments, that it will improve financial inclusion, that it improves privacy somehow, and that it will improve intermediation. But most of these, I think, don't hold up. Payments, in that case, I think that you already mentioned the concerns about private networks. I'll come back to that in a moment. On inclusion, public instant systems do the job at least as well as central bank digital currency. Brazil's PIX works extremely well, as does India's UPI. They don't have central bank digital currency. Privacy will depend on design. Disintermediation and intermediation is an issue. The central bank can mitigate the risks, however, I think, by recycling funds back to banks. Doing so is a bit risky because it turns the central bank into a credit allocation mechanism in the country. But as I suggested a moment ago, the serious case for central bank digital currency, in my mind, comes from the idea of using it as a payment infrastructure. It creates a public option along with the private ones. It's very clear that the digital euro system will have this capacity, and I would actually support it based solely on that. Even if you couldn't hold any of it as a store of value, it would still operate as a payment system. Now, what about stablecoins? Returning to the private monies. These are neither central bank money nor bank deposits, so they're not money in the sense in which we currently think about it. Also, when you give Cercle $1, Cercle does not extend credit the way that a bank does. It puts your dollar in a reserve fund of short-term treasuries and bank deposits and gives you what it calls a token, a digital representation. The structure is one of money market accounts, not banks. And I think that there's a cautionary note there because we know that, that money market funds can be fragile and require government support. This has happened on several occasions. In fact, 3 in the last 15 years, one in 2008, again in 2020, and a third time in 2023. Now, as you mentioned, Tether and Cercle, the 2 biggest of the stablecoin issuers, dollar stablecoin issuers, hold large quantities of US treasuries and also other things. We learned that we don't know that much about Tether, but we do know that they hold gold and Bitcoin and all sorts of other stuff. When there's a run on the large stablecoin, the issuer is going to dump treasuries. And so the problem here is that if you look at the money market fund analogy, that we know that if stablecoins become large, that the Federal Reserve or any central bank is going to have to step in. So as technology changes the nature of private money, then the question that another question that you asked and that we cover, I think, in the report is how should we think about regulation? The answer that we give is that we should adopt the principle of functional equivalence. 2 instruments that perform the same function in the financial system and create the same risk should face the same regulation. The structure of the database, the nature of the code, the design of the protocols, that doesn't change anything. Now, in the report, we talk about 3 frameworks, the Genius Act in the US, MiCA in the EU, and then there's a Bank of England proposal for how to handle stablecoins. They answer the central question about stablecoins the same way, which is that a private liability cannot function as money at scale without central bank support. And since these instruments then are global, national regulation, we also discuss, is not going to be sufficient. The bottom line here, though, is this. The future of digital money is going to turn less, I think, on technology itself than on whether the central bank is going to stand behind this stuff. Private liabilities that are backed by the central bank circulate as money in mainstream economies. Private liabilities without that backing don't have the general acceptance that's required for them to function as money. Let me stop there, and I look forward to the discussion. Thank you.
Thank you. So with this introduction, so you mentioned the digital euro. In principle, there is this project that we'll see whether it really succeeds. To introduce the digital euro in 2029. And a question for Martin. Do you think the Eurozone needs a digital euro? Does the UK need a digital pound? I recall this report of the House of Lords, that asked whether it was a solution in search of a problem. Okay, so I remember an exchange with Mervyn King, a former governor of the Bank of England, in which was quite critical of this, introduction. So how do you view that? Do we have to go ahead or not?
Okay. So first of all, it is, I think, relevant just to comment on what Steve said. I basically agree with what he said. To me, so-called stable coins are obviously, like, when people say things like that, they're frauds. They're completely stable until they aren't. And in those circumstances, the only thing that can make them stable, it's a run, is if the state backs them. And any financial system that has the implicit backing of the state has to be regulated by the state. And that's the great lesson that I took from the global financial crisis, but you take it from monetary history, because it's an immense privilege to issue something that looks like money. People will believe it's money, but if they suddenly find, because of some shock or other, and it's so easy to imagine some, that it doesn't work like that anymore because people won't accept it as money, when you really need it in a crisis, Gary Gorton's great point of Yale, then the state has to back it. So stablecoins are fine if it's perfectly clear the Fed stands behind it, which is basically the US government. But that is a very, very big implicit fiscal commitment by the US government. And I'd like to remind everybody here, because it's the most important financial fact of the last quarter century, that in October 2008, the banking system of the world was saved by the entire balance sheet of the G7, essentially, being put behind it. Total balance sheet. So there is no such thing as a private banking system, and this applies also to stablecoins. That's clear. Now, I actually think there's a perfectly good case, when it comes to the digital currency, for saying, but I won't go into detail, yeah, we could solve this problem if we made it clear that all money is in fact a liability of the state. It's possible. And a central bank digital currency could be a way of getting there. So basically, we ended up with what we have. Banks supply most of the money and look after most of the money in the world. But the main reason for that, you could say, is just that, well, 200 years ago, we couldn't all bank with the central bank. It was technically impossible. They didn't want to have branches everywhere, completely hopeless. So they allowed all the banks to create their own money in the ways we all know. But when there were runs, as Bajot explained, you had to back them. So they became subsidiaries of the state, more or less regulated, and every time there was a crisis, they came in and helped. Okay, that's what we ended up with. So central bank digital currency might make sense. Of course, it's not going to happen. If they said, okay, we are going to compete with banks, we are going to issue the only safe money in the system, and we're going to use it to back the government. And so central bank digital currency would become the dominant money in the system, but of course that would completely implode our financial system as we know it. One could imagine how it would work. But if that's not what you're doing, then I really don't know what you're doing. Having a small amount of cash substitute, which is central bank money, which is nowhere near enough to be something that to which people could run in a crisis. You still have the central bank supporting all the banks and possibly stable coins and all this other stuff as well. I simply don't understand what this small dollop of central bank digital currency would add to anything except possibly trigger to some degree runs in a crisis. So either you're serious about this, we are rethinking money, which is possible, but obviously far too radical, or you should go home and admit that the system we have is the one we want. We can make banking money better by tokenizing it, so forth, technically better, but in the end, the system we have is what we want. And if we want stable coins too, we have to make it the part of the same network. Those are essentially the choices. And central bank digital currency, in my view, in this context, is sort of a complete irrelevance, and I don't see why Christine Lagarde, who's a very sensible woman, is in the least interested in it.
Okay, that's an interesting point of view. Before turning to Maria, on the view of the private sector, basically, of the same issue, on the crisis and the 2008 crisis, I still remember that I think it was President Rodrigo Zapatero said that just before the Spanish banking system also was about to collapse partially, at least, he said that the Spanish banking system was the safest in the world. Okay, so, but obviously he could not back it up.
I'm very pleased to hear it.
Yeah, exactly, but they could not back it up. Maria, okay, so what's your view on the central bank digital currency, private sector solutions? Can the private sector offer an efficient payment solution, and we better forget about the central bank digital currency? Well, in particular, on the radical version of Martin, because then maybe banks could be in trouble, no? Could the central bank digital currency kind of also, by diminishing deposits, kind of put in danger credit, no, in the sense of lessen credit? How do you view all this?
Okay, so the view here is that we have been discussing digital euro now for a while. We've been extremely slow in the thinking and finding a bit the problem for which we were trying to apply the blockchain solution and the DLT technology, because in Europe in particular, we are all managing efficient payments, and on a daily basis, we do not face significant challenges on payments. At the same time that Bitcoin blockchain has been developing, also as different infrastructures in Europe have been evolved, especially instant payments, it has been more obvious that there was no clear need for a retail use case of digital euro. And actually, CaixaBank was one of the banks participating in the first pilot with ECB in discussing and really checking with customers how to use the retail digital euro. And there has been a lot of discussion whether we should push for retail or wholesale use cases, as in other jurisdictions as well. Because we've been very slow, and this requires also a lot of political alignment among all the European countries. I think the environment has changed a lot, and now the way the central bank positions digital euro, and I think we are all in these discussions, is not so much about an innovation as a means of payment, but also how we need digital euro for some systemic reasons, especially because in the context of increased push in some jurisdictions like the US about stable coins and other means that entail significant risks for the system, how Europe needs to react into this new situation. So I think that right now a lot of the discussions and a lot of the project that is still ongoing, thinking about 2029, is more about how we provide a new rail that provides resilience and sovereignty to Europe, and also stability, and defends the position of public money in a context where we see more and more private platforms, more big techs being part of this. Some misalignment that it's also raises questions regarding the different regulations.
Is Europe behind in the digitalization of money?
I don't think Europe is
from China and the US, or not?
I think here we have a lot of panelists that have a very strong point of view as well. I think at European level, we are all very advanced now in trying to develop instant payment capabilities that can interoperate. Because of the current situation and geopolitical situation, I think we've moved faster into pushing for the peer-to-peer systems and instant payment solutions to being interoperable between countries. So we have, Spain is one of the success cases with Bizum, but how we can connect these networks among different countries. And this is one of the discussions we also have with the authorities regarding that. This is also a new resilience system compared to traditional payment cards and other alternative rails. There's also in some countries that are heavily dependent on digital money, that it's not the new forms of money, but I remember maybe 5-7 years ago that some of the Nordics, there was a very advanced initiative, I think in Sweden, that they were also thinking about central bank digital currencies as a resilience rail against cyber attacks or cyber security in the card network. So having alternative rail payments, I think it's something that is good. I think that the use case for digital euro in particular, it's a bit of a challenge because we have the problem as users quite solved. And then it needs to be well designed. Otherwise, we are going to be in trouble because we need to make sure that in terms of holding limits, in terms of the two-tier system, we keep things quite clean.
Yeah. Let me ask something. So we see cash declining, right? But we use still a lot the debit and credit cards. Mm-hmm. Until when? Until when will we use this old-fashioned system of credit and debit cards? What do you think? They will be replaced by all these digital wallets and or not?
I think what we see, at least, what we see from the user perspective is that we are moving into a more fragmentation of means of payment. So especially new generations, they already even use different cards for different occasions. So you are going to use a different payment method depending
For different things.
For different things. This is definitely a trend. For me, for example, it's difficult to realize because I'm 50, I'm not 25 anymore. But new generations, they have this behavior in terms of retail.
Yeah, no cash. Yeah.
Yes, I think it's a mix of experience, user experience, also mix of cost of certain rails, and then of course technology.
Yeah.
And the big unknown here is also how artificial intelligence and all the new digital money in terms of tokens and programmability allow to develop a set of new use cases that technology companies are very interested in pushing, and there will be new needs that the traditional payment rails, especially cards, cannot develop.
Yeah. Martin, what do you think? So will we keep using these credit cards and will be replaced soon? Will we be hybrid or?
This doesn't seem, I mean, to me, in my own personal life, for somebody like me, it seems to me sort of irrelevant. I use digital cards on this. The payment system, compared with what it was when I was a child or young, is stupendously quick, efficient. I would have thought the only area where this might really be relevant is transformations in wholesale payment, particularly cross-border wholesale payment. That's not something I do, but it seems to me maybe we can make it a bit more efficient. But I think that I'm very much with Steve, and I think the fundamental issues are how do we want our monetary system to interact with and shape our financial system, which is really important, and how do we want to interact with our fiscal system, which is the state. These are absolutely fundamental conceptual issues. And there I think we could have a legitimate discussion because there are really big ones here, because the simple truth is the current monetary financial system is a public-private partnership in which the state is inextricably linked to and supportive of some of the biggest private companies we have in our economy, which do central things. That's a big issue. The rest of the debate we're having about technology seems to me really second, third order. It's obvious the US government wants to fund its colossal fiscal deficit with cheap money, so it's monetizing it in a different way. It'll end up with the Fed anyway. So that's, to me, a fraud. But that, I understand the politics of that. Yeah. But I think that's not what we should focus on. Again, with the central bank digital currency, that's not the issue. I think technology triggers the debate, but it isn't, to me, the heart of the debate, because what we have is a financial system with massive moral hazard in it, which is important and inherent in it, and, of course, fragility associated with that, and there are questions whether that's what we should want. The rest of it, to me, is sort of secondary.
Okay, so we don't have a lot of time. Martin, I would like to follow up on you more on the international aspect, on the international monetary system. So in the report, we think about possible scenarios where one would be like unipolar, where the role of the dollar is reinforced with those stable coins, and it becomes even maybe more dominant, no? Like with the centripetal force. But also there could be, because of geopolitical reasons, a multipolar world, no? Where the yuan has its space, the euro manages to get some, to get more established, and then maybe the different systems, if it is multipolar, will be integrated or more fragmented depending on interoperability of the platforms. Where are we going? So what do you think? Are we going more to keeping dollar dominance or a weakening dollar dominance with more multipolar system? How do you view the future?
What Steve thinks about it. I suppose my view goes something like this. Clearly, this administration is extremely interested in preserving the dollar's role and feels that to some extent it's under threat. Two, it sees stablecoins particularly stable coins, as a very important means of achieving two things: funding the US government and, at the same time, ensuring the continued centrality of the dollar as the global money. So that's how they see it. And it is clear that other parts of the world, the Europeans and the Chinese, see that as to some degree a threat. That's clear. Whether it really is a threat, I don't know. Whether it will be destabilizing, I don't know. Now, that should be set in the broader context about money, which is money is about trust, of course. And one of the reasons the Americans are concerned about this is they are concerned about the possibility, at least Scott Bessent is, that people are going to increase their distrust of their dependence on the US because of the way US policy is working, sanctions, possible inflationary pressures from their fiscal policy. They don't want people to leave the dollar system, and they are aware of vulnerability there. That creates opportunities for others, and it might mean that the system tends to fragment. But then I'll make my final point. In practice, I think in the short to medium run, unless the US does something truly crazy, the alternatives aren't really...
Is that possible, that they do something crazy?
Of course it is. I mean, under the comparison system administration, of course it is. You can easily imagine something that blows it up. But I'm not saying it will happen. I'm not saying at all it will happen. But the Chinese cannot replace, the yuan renminbi cannot really replace the dollar in its crucial functions because it doesn't have an open financial system, and it's not going to have one because that violates the first principle of Chinese Communist Party life, which is we control the domestic economy. And if you have a completely integrated open capital market, you don't. So that's, I think, not going to happen. For Europe, there is a real challenge, which is, do we want to promote the euro seriously, and therefore the European financial system, as one open to the world?
What should we do?
Well, I would have to say the first thing I would do, if you're really serious about this, is creating a European debt market. I mean, and with that, a European financial system. If you do that and you have a single currency and it's open to the world, you become a pretty serious rival. But as it is, people trying to use European assets, operate in the European financial system, there isn't a pole in the same way that the US offers, and therefore you can't beat the US with what you've got.
We are running out of time, but I would like to ask Steve one thing that he's keen of, and I think it's important for the banking system, which is, Steve, you should appear at some point.
He's over there anyway.
Oh, you're over there already. Okay, I didn't see you. Sorry. Is the question of this digitalization of deposits, the tokenization of deposits. So instead of going the route of stable coins, maybe banks could make this digital twin of deposits and then operate with this digital twin. We have very, very short time, and we'll be cut off if you are not short. So please answer very, very shortly. Okay.
So I'll be very short. My answer to that is yes. I think that the large banks will and are creating tokenization of deposits that have all of the benefits that stablecoins could offer in terms of things like programmability and 24/7, 365 settlement. And that's where people will go because of the reputation of the banks and the functionality of the deposits that they already have. The payment systems that we have will be connected to that, and I think that then I agree with everything else that Martin said about our need to understand how that system actually works and interacts with the fiscal authority and with the real economy.
Okay, thank you. So I think we have to close. We have some other interesting questions, but we'll have to defer them. Some of them have already been answered by our speakers. So in conclusion, I guess what we can see is a hybrid world, a hybrid monetary landscape, probably fragmented across jurisdictions. We'll have stable coins, we'll have tokenized deposits, these things will coexist. In some jurisdictions, this will be joined with the retail CBDC. In some others, maybe in the US, it will not. The US will try to project the dollar dominance through the stable coins and trying to get a benefit for the debt, so that their debt is absorbed by the market. The European Union will see exactly if it managed to get its act together. I know that the European institutions are thinking seriously on how to promote the debt market and the European safe asset. They do not agree how. Okay, let me tell you, that's no secret. But they are thinking about it, and there are projects, and we're working on projects in this. And then finally, one thing that we did not address, but maybe this will be another session, is cybersecurity. So the threat of cybersecurity posed by artificial intelligence, and eventually by quantum computing that may decipher the encryptions, will impact the banking system, and it's impacting us. So I mean, we have lots of phishing and all kinds of scams that come through our phone. And so technical integrity, so apart from the institutions, so technical integrity of the system will be, I think, very, very important. So thank you very much, and so I think we can go for dinner.
Maybe we'll go back to paper.
We'll go back to paper, exactly. So, in fact, yeah, some fakes were done, but they're more difficult.
Or gold.
Yeah, exactly. Thank you.
Thank you.
Thank you.